Hello, this entry into my online journal is going to be my weekly review video. So, on the weekends, there are two things I do. I review the trading week that has just passed, and I plan for the week that is to begin. This particular entry is to review the price action of the previous week. I'm going to be looking at what happened. I'm going to be looking at opportunities that I planned for, trades that I took, opportunities that I missed, how I managed the trades that I took, and if there is anything I can learn from price. Before I go into it, I want to do a quick recap. So, last week, when I did my forecast video planning for this week that has now ended, this is where price was. Price was at this huge bearish weekly candle. This was the US election week. And I had told myself that I was looking for price to trade up into this daily fair value gap. At the time, this daily fair value gap was the only at the time this daily fair value gap was the only point of interest on the charts. But as we know, what happened was as soon as the week opened, price basically did not give any entry, just traded all the way down right from Monday and closed near the lows of the week. Last week and this week have now created this weekly fair value gap, but I'll talk about it in my forecast video planning for next week. So, this is my review of the trading week that started on, I believe it was the 11th of November and ended on the 15th. If I put my horizontal bar here and go down to the daily time frame, you will see that all of this, so this is Monday's price action, Tuesday, Wednesday, Thursday, and Friday. Actually, what I'm going to do is I'm going to take off all the drawings, all the position tools, and analyze the chart from scratch. I'll do this on Euro USD, I'll take a look at GBP USD, and I'll take a look at gold because those were the three pairs that I spent the most time taking a look at this week. So on the daily time frame, this was Monday's price action, traded up, um, had a small wick to the upside, then traded all the way down. I will go down to the 4 hour. So what I'm going to be doing is I will be looking at daily fair value gaps that were formed, 4 hourly fair value gaps that were formed. For my points of interest, I do not go lower than the 4 hour. So I don't take, for example, I don't consider 1 hour fair value gaps, 30 minute fair value gaps, 15 minutes, and all of that for my points of interest that I take trades from. I may use lower time frame points of interest to scale into positions or to gauge what my trade is doing after I have entered it, but I do not draw fair value gaps on any time frame lower than the 4 hour. And I don't, you may or may not have noticed, but I color code my points of interest. So my weekly gaps are color coded purple, my daily gaps are color coded red, my 4 hour gaps are color coded light green, and my monthly gaps, if I go on the monthly, are color coded dark gray, black. So, same thing with my PDRAs, my trend lines. So, a weekly, for example, a swing point that is visible on the weekly will have a purple trend line, purple to indicate weekly swing points. Daily swing points or daily highs, daily lows are color coded with red. Same thing with 4 hourly lows, green, and so on. So this is the price action for this week. Monday traded down. There was no entry on Monday, no real opportunities. And then Tuesday created a fair value gap between Tuesday's high and Friday's low. So if you go down to the 4 hour, what we can observe is that, so this is Monday's price action. Monday created this fair value gap and it did not trade into it. So let me color code that 4 hourly. Now, when this happened on Monday, this 4 hourly fair value gap became my new point of interest. But when it did not get traded into, did not give me an opportunity until Tuesday, that was when I established this daily fair value gap. Now, if you look on the 4 hour, let's look at the price action for Monday on the 5 minutes, on the 15 minutes rather. So Monday's price action, this was the Asia range. It traded, consolidated, and as soon as London session opened, London was super bearish, traded lower. New York also traded lower, then consolidated going into Asia. Then Tuesday was where my first trading opportunities came along. So what we see is that Tuesday, with more of a stair-step in price action, still traded bearishly. Now on Tuesday, this 4 hourly fair value gap was created during Tuesday's price action. So if you go on the 4 hourly, you will see that this particular fair value gap right here between this candle's low and this candle's high was created. Now I noted that out because it will become more relevant as we go further into the week. Now, what happened was that on Tuesday, I was looking for this weekly, denoted by this purple line. I was looking for this weekly low to be traded into and traded through. My plan was to see some bullishness after that low had been taken, because typically there are reactions when higher time frame swing points are traded to. And what happened, if you remember from my post that I made during the week, was that price traded into the area of interest. So this is Tuesday's price action. It traded into it at this point, but it traded into it at London close and did not give the sort of, so it traded into it London close, then it consolidated for 1, 2, 3, 4 candles on 15 minutes, then it gave the engulfing candle that is typically my strategy. My strategy again is I want to see price take liquidity into a higher time frame PDRE, then give me an engulfing candle on the 15 minutes. That's my strategy. So price trades into a 4-hourly fair value gap, gives me a 15-minute engulfing. That's my strategy. After taking time-based liquidity, daily fair value gap, after taking time-based liquidity, gives me a 15-minute rejection candle. I take that trade. Now I did not enter this position because the entry happened after. This is London kill zone, this is New York kill zone, this is London close kill zone. So the market was essentially already at the end of the day before it gave this entry. That was why I did not take the trade. And if you see what happened is that price traded, went higher a bit. At the height of this trade, it gave about a 1:2, almost a 1:2, which would be a good trade, but it did not follow my rules, so I did not take it. Ultimately, of course, if I were to enter this trade, my target would be this 4-hourly fair value gap, bearish fair value gap, because I know that price is bearish. And so this is just a short retracement trade into an area of interest that has been created in the direction of the predominant trend so that the bearishness can resume from here. This trade ultimately ended in a loss, if you see, during London kill zone the following day. This was Wednesday. So this trade, if I had taken it, would have resulted in a loss. We move on from Tuesday and come into Wednesday's price action. So this was Wednesday's Asia price action. It traded all the way down. And then during London kill zone, now this is a trade that I did not take. Whether or not I consider it a missed opportunity, I can debate that later. But it did give me an entry. The reason I did not take it, I will get into right now. So what I like to see is, since this setup over here happened outside of my trading hours, for me to still capitalize on this particular opportunity, I would need this low that was created, because I expect it not to hold, not to push price all the way to the target. I would expect it to get traded through, which is exactly what happened here. So remember, we are still trading below this weekly swing point, and now a low that was created at that swing point essentially got traded through. This gives me extra interest in going long from here. So after this low was taken out in London session, we see that there was no huge engulfing candle, but there were 3 candles that engulfed it. Now, if I wanted to take this trade, you'd see that it might, it might be more visible on the 30 minutes. So you see that this candle did not engulf the previous one, but the one after it engulfed it. If you look very closely, you see that this candle's close is higher than this candle's open. So these 2 candles together engulf the previous candle. Now, if I wanted to take this trade, this would have been my entry right here. My stop goes below here. That's why I've put this position so there. Now, my target would have again been the 4-hourly fair value gap, and it would have netted me a 3.4-hour trade. But I did not take it, and here's why. This was the London kill zone of CPI day. Now we'll take a look at what CPI did. And because of that reason, I do not like to be in the markets before CPI. I was worried that I could take this trade and then price just consolidates, maybe hovers around my entry in a bit of a drawdown, builds up, doesn't really go anywhere until it's time for CPI. So to protect my mental capital, I just like to avoid CPI altogether. Or it could have just taken me out for a loss. You don't know what it's going to do. But fortunately, this time around, it played out beautifully and hits the target before CPI. So if I had taken this trade, I would have been in and out of it between London session and the start of New York Open. Now, this trade I did not take, so we'll take that position to off of there. And this was what CPI did. Beautiful price action. Now, again, I do not like to trade CPI itself. I like to wait until usually the day after CPI so that I can see what structure points CPI creates. If CPI gives me any huge fair value gaps, which it did right here, this huge 4-hourly fair value gap was created on CPI day. But that will become relevant as we go into Thursday's price action. So CPI candle did this. When this candle opened, I remember looking at it, it spiked all the way up through the 4-hour fair value gap and then gave a huge rejection, closed, was still a bullish candle, but there was a huge wick. Now, under normal circumstances, this would have been a trade entry for me as well. I'll have about a 22 pip stop, and then I target a 1 is to 2 or a 1 is to 3. Now, you see that these relatively equal lows here and here will not have given me a 1 is to 2. So I aim for the entire range 1 is to 2 or a 1 is to 3. And we see that even a 1 is to 3 got delivered same day, 70 pips. Now, the reason that I did not take this trade, remember, Tuesday's price action at this Asia high created this daily fair value gap sitting at top price here. And from my experience, if you have a 4 hourly fair value gap and a daily fair value gap above it, a lot of the time what tends to happen is that yes, it will give a small reaction. Maybe you see 1 is to 1 on the trade or 1 is to 1.5, but ultimately it tends to reverse because there is a bigger, stronger magnet. If you believe that fair value gaps act as magnets for price, the daily fair value gap will often attract price, taking you out of your early position and then give the entry from the higher time frame fair value gap. So it has happened to me many times where there's a weekly fair value gap sitting on top of a daily fair value gap or sitting below a daily fair value gap when I want to take longs. And then I take the trade from the daily points of interest. The trade moves a few pips, maybe 1 to 1, doesn't really get to my target, ultimately ends up reversing against me for a loss, dips into the weekly fair value gap, then trades away. So because it was one, it was CPI. It has happened many times in price where you see the CPI candle. Yes, it will do this, give the rejection, but then the following candle will just straight up engulf all of this price action and then just continue to do this, ultimately trading into the daily fair value gap. I have seen that happen so many times. Straight into the daily fair value gap, then gives the move. So unfortunately, this what did I do there? So unfortunately, this particular entry, this particular setup was not a good one for me to take. One, because of course the CPI and the volatility can be crazy, but two, because there was a daily swing point on top of the point of interest from which the bearishness started. Now, in this particular scenario, it did work out. It did play out, give a beautiful 1 is to 3. I did not capitalize on it because my trading experience tells me not. So that was another missed opportunity. Now, when you continue into, so this price action, this is Wednesday, CPI, the price action of CPI, this was CPI's price action. It created this huge 4 hourly fair value gap. And then Thursday's price action traded into the 4 hourly fair value gap. So there was another opportunity on Thursday. So now this is the 4 hourly fair value gap. If you just mark out this high, we'll go down to the lower time frames to see what that looked like on Thursday. So after Wednesday's price action, this was Wednesday's price action. After Wednesday's price action, after CPI traded lower, you see that the Asia range, Thursday's Asia range essentially just did this, traded all the way down. Now, what happened was and also Thursday was PPI, another day that I did not really want to trade. So I stayed away from the market during PPI. But if you go on the 4 hour, we can see something very interesting. You can see something very interesting here. You see that there was a small fair value gap that was created right here between, okay, sorry, I think that's my mistake. I'll take that off. Okay, I think it was a 1 hourly fair value gap. The price bounced off of, but I'm not interested in hourly fair value gaps. Yeah, okay, this was it. 1 hourly fair value gap. Price traded into it at this point and then traded away. But it traded into that 1 hourly fair value gap that was created in Asia session. So no real liquidity was taken. I remember I put that on my chart because I saw another trader who posted a screenshot of them taking that trade at the lower time frames. But I digress. Thursday's price action did this. Now, you see that price traded into this huge fair value gap, this 4 hourly fair value gap. At the end of the day, so this was London Open, traded very much bearish, then started reversing into New York kill zone. Now all of this was PPI's price action. This particular candle was PPI's candle. This candle that went bearish, then came back up, then ultimately continued trading bullish. Now you see this was Asia high. Asia high got taken out. This is not time-based liquidity, but it is a swing point. So when you combine Asia high plus this high, got taken out at London close kill zone. You see, now I do not like taking trades at London close because it generally tends to mean that you have to hold that trade overnight. But you see that it gave a beautiful reaction when price traded into it. These two candles that followed engulfed it. So again, this would have been the entry. The stop goes above because it's a 4 hourly fair value gap. Now, admittedly, it's a huge fair value gap and it barely tapped into the discounts of the fair value gap, which is why, again, so PPI day, London closed, I decided not to take it. But if I had, actually the same day, it would have given me a beautiful, and now, of course, the target would be the next prominent low, which would be this low that was created during New York kill zone. So this would have been the target, and then it would have given us a beautiful 2.3 hour trade. That's another opportunity that I missed. But what happened was that between this high that was now created inside the 4 hourly fair value gap, a daily fair value gap was created between Tuesday, Wednesday, and Thursday's price action. So this is the daily fair value gap that was created here. This is Tuesday's price action. This is Wednesday's price action. This is Thursday's price action. So you see that the high of Thursday, this high right here, is what formed the low of the fair value gap. Now, that proves important and instrumental going into Friday because now, although the 4 hourly fair value gap was tapped into, a daily fair value gap, although it is small, was now created that price had not yet tapped into. And so this was Monday, no trade, Tuesday, no trade, Wednesday, no trade, Thursday, no trade. The bearishness just continued. And on the days when there were trades, there were high impact news days, and so I avoided the market. But on Friday, this is what happened. I waited for this trade on Friday. This was Friday's price action. It opened Asia session, did its usual thing. Then, during London session, price traded up into this point, and I thought that price was going to give me an opportunity to go short inside this daily fair value gap during London Open because there did not seem to be any reasons that the price would not trade into this point. What happened was that price came to the 4 hourly fair value gap. Remember, there's a daily level nestled inside the 4 hourly level. And so what happened was that price got here and stalled for the next 2 hours between the end of London Open. Look at this, all this ranging price action came close to the high, went back down again, creating a double top. And in my video forecasting this trade, I mentioned that this high, this high, this high created relatively equal highs, which give me a stronger bias going into if they get traded above into it. So this is a textbook example of an A plus trade setup for me. You see, time-based liquidity. This is yesterday's New York high. This is today's London high, sitting right below a daily fair value gap. And then during New York kill zone, price trades into it. Now, my analysis and my breakdown of this trade is posted in another video, so I'm not going to overflog it. Price traded into it, gave a small reaction on the 15 minutes right here. But this particular week, one, the candle was still a heavily bullish candle. Two, I needed to see an engulfing. But because on Friday, at the time when all of this was happening, retail sales was about to come out, I entered a small position because I knew that the retail sales candle had a very high chance of being huge, which is exactly what happened. So if I had been waiting for retail sales candle to close, normally I would want to see it engulf only this candle, but it ended up engulfing this candle, even the candle before it. And so my risk to reward would have been terrible, just a 1-to-1. Because of that, I entered right before retail sales, but I went in with very minimal risk, the smallest possible position size. I went in with very small risk so that if the trade goes in my favor, I can make a decent percentage return because the risk to reward would be very good. As price started melting, I entered additional positions. Cumulatively, I took 7 hours out of this trade. The trade breakdown is contained in my previous video. And so that was the price action and the trading for Euro USD for this week that has just ended. I closed the week on Euro USD with about 7-hour profits. GBP USD did not do anything that I was really interested in. You see, all the points of interest were left open. Daily fair value gap did not. I have an alert there, did not trade into it. 4 hourly fair value gap that was created on the lower time frame, again, gave me equal highs, sitting above it, did not trade into it, just melted. So no action on the pound dollar. Now, gold was another interesting one that I want to analyze because I missed a trade on gold that actually hurt me a little bit. It's because I took a loss on gold. So as you know, let's go to the weekly time frame. On the weekly time frame, you see that yes, there was a weekly swing point here. Swing point visible on the weekly, also on the daily. On the weekly, it's a single candle. On the daily, it's much more prominent. So I used the daily marker to signify this swing point. But you see that below that swing point, and here's something I should have known. There's a mistake I made that I don't want to ever make again. This is something I should have known. Now, if you see between this candle's high and this candle's low, there's a daily fair value gap in this area. And typically, again, from my trading experience, when a fair value gap has been tapped into, even if it's once, so you see, this is what happened. Fair value gap, fair value gap, fair value gap. This is more visible on, it's even visible on the weekly as well. So let's say weekly fair value gap, price tapped into it on this week and then rejected and gave another 1, 2, 3 weeks of bullish price action. I should have known. Now, I was only looking at it on the daily, admittedly, which is why it's very important to do higher time frame analysis, full top-down analysis. Because if I had just scrolled at the time when I was getting into this trade, I remember I was only looking on the daily. If I had just zoomed out to the weekly, I would have seen that this swing point that I wanted to use as support for a short-term trade long was trading that had tapped into a fair value gap. And so you can no longer expect this fair value gap to hold. That's happened to me many times. Sometimes you have a huge fair value gap. So let's say this fair value gap had this range, for example. There are fair value gaps like this, sometimes on the daily, sometimes on 4 hour, when CPI or NFP candles just go ham. Now, what happens is that price will do something like this. Price will tap into it very lightly at the top here, and then take off for another, let's say, 1 or 2 weeks. Now, what some traders tend to do is they adjust the fair value gap to something like this, forgetting that it has actually been traded into already. This is not the fair value gap. The actual fair value gap is something like this. So there's a fair value gap that has been traded into, although not completely, not deeply, and then price bounced away from it. Typically what happens is that if price comes back down into that fair value gap, if you're not aware that it has already been partially mitigated, you may be expecting it to push price away again. But it has already done that. It did that in this price leg. So a lot of the time, and this has happened to me multiple times, price comes back down and then just simply continues trading through it, completely filling it up, heading for either a low beyond the fair value gap or another higher time frame fair value gap under it, which is exactly what happened this week on gold. So if I was aware, I would have known that this point of interest was not a high probability one because it was inside a fair value gap that had already pushed the price forward. So I'll take up this fair value gap. Now, my small loss on gold, I also recorded it during the week. Now, admittedly, gold is not an instrument I trade a lot. I just wanted to see how well my strategy performs on gold. I want to test it. So this is what happened. On Tuesday, it was, I believe, price traded. This was Tuesday's price action. Price traded. This was the trade. Price traded into that area, gave this engulfing candle, and there was this huge four-hourly fair value gap that I was targeting, and there was Asia highs sitting right below it. So it was a beautiful target. Unfortunately, what price did was this, just consolidated a bit, took me out, and I took a small loss on gold. Now, maybe that is what made me to stop looking at the pair. I was just like, I tried gold, I took a trade, didn't work out. And of course, during CPI, PPI, I was not trading. But this is what happened. As gold continued to trade lower, creating fair value gaps, creating points of interest, 4-hourly points of interest, daily points of interest, it traded into a weekly fair value gap. And it did this ahead of CPI as well. So you see, this was when gold traded into, let's see, when did it happen? It happened on, let's go down to the 15 minutes. If I was vigilant, if I was taking a look at gold, there was such a beautiful entry on gold. So let me zoom in. Let me zoom in to this price action very well so it's clear. Yes, so this was PPI day. Now, PPI is not as volatile as CPI and NFP, but it can do some real damage, especially so. My experience with PPI usually is I might be in a trade already. The trade might be in 2-hour profits or 1-hour profits, not yet at the target. And I would be hoping for PPI to push the trade to take profits. And a lot of time what PPI will do is that PPI will just reverse the trade, take me to break even, or sometimes it will take me out for a loss. So I don't stay away from the markets if there's PPI, but I like to exit whatever position I'm in, especially if it's profitable before PPI, which is why I would have taken this trade. Now look at this beautiful price action. This was London session. Kill zone, denoted by this dotted green box. Price traded into the weekly fair value gap. Beautiful A+ setup. Gave a huge bearish candle. This candle had a small wick. You see this wick right here from this point to this point. And I like to see that kind of price action because it means that on the lower time frame, on the 1 minute, on the 5 minutes maybe, some bullishness has begun to come in, and traders might get eager and start longing from here. So I like my entry candles to take out the wick created by the previous candle and then reject, which is exactly what this 15-minute candle did. This is a perfect entry candle. It is a bearish candle, but that does not matter because it's a hammer candle. So you see what happened was that price traded all the way down, dipping very well into the weekly fair value gap. This is more than 50% of this range. Dipped into the fair value gap. And it's a weekly fair value gap, so they tend to push price a lot further. And then closes right at the opening. Now, if I was at my chart, so now the reason the position tool is here is because I was not looking at gold when this happened. If I was, this is what I would have done. This would have been my entry. and there's so much to target.